Welcome to the Titans of Industry weekly interview, and this week I am very pleased to have Mr. James Turk, founder of GoldMoney, with us to talk gold and silver and really boil down what's going on in 2017, have an outlook on what he sees in the next year or two, and go back to 2016 and recap this amazing year that gold and silver had, and gold and silver mining shares as well. James, how are you today?
Yeah, great. Good to be with you.
Okay, excellent. I want to start with something that not many analysts have picked up on, and this is a very important indicator of what 2017 can be like. In 1971, on the 15th of August, Richard Nixon closed the gold window and made the entire planet go on a fiat monetary system in essence. And the Fed raised rates for a tightening period between 1972 and 1974. It then raised rates again between 1977 and 1980, and it then raised the rates the third time, a third tightening period between 2004 and 2006, and now we're witnessing the fourth ever tightening period inside of this 45-year window where we're basically on a fiat monetary system. Every time that has happened, and the last 3 times, gold and silver prices rose incredibly and outperformed the S&P 500 and broad stock indices after the second rate hike. Do you see the same thing happening in 2017? We just had the second rate hike in December of 2016.
Yeah, you're raising a good point, because what it's basically saying is that the Federal Reserve is always behind the curve. As the saying goes, they're too slow taking away the punch bowl. They put a lot of money in the system. That money eventually creates inflation, and then the Federal Reserve reacts by raising interest rates, but they're always too late. So what happened in the 1970s, as an example, is that the real interest rate, in other words, the interest rate after adjusting for inflation, was basically negative until Mr. Volcker came into the Federal Reserve and really raised interest rates very high, so that the real interest rate after adjusting for inflation was 5 or 6%, which is unprecedented, because a normal real interest rate should be between 1 and 2%. What that basically did in the early 1980s is ended, the inflationary spiral that the United States had been moving into, and also ended that bull market in the precious metals. What we're seeing now is basically a repeat of the early 1970s. There's been a lot of money printing, a lot of pumping of liquidity into the system, and we're seeing that being reflected in higher stock market prices, for example. But what we're basically facing, going forward from here, is a replay of the 1970s. Slow economic activity and higher inflation. In the 1970s, we called that stagflation, and I think that's going to be the big theme for 2017 and beyond. Slow economic growth and rising inflation as governments around the world try to deal with all of the debt that they've been adding onto their balance sheets.
That's an interesting point of view, and I want to elaborate on that. In 1970s, the U.S. was the largest nation on the planet, very rich country, and Asia was out of the picture. Now, India and China are powerhouses, and their gold and silver demand is much larger than it was. Their purchasing power is much larger. Their middle classes are much larger. Their urbanization is much more in effect. Do you think this will impact gold and specifically silver prices, because silver is an industrial metal and it finally can surpass its 1980 high? Is this true that silver is the only commodity on the planet that has not had an all-time high in 36 years?
Yeah, that's true. But let's get back to silver in a second. Let me just address that first point. You have to remember, and people lose sight of this, but in the 1970s, the U.S. was the largest creditor nation in the world. Now the U.S. is the largest debtor nation in the world, on the planet, probably the largest debtor nation in the universe. There's so much debt that it's added onto its balance sheet. So it doesn't have the flexibility that it did back in 1980. The Federal Reserve doesn't have the flexibility. Mr. Volcker could raise interest rates high when you're the largest creditor nation in the world, but Ms. Yellen cannot raise interest rates to sky-high levels like Mr. Volcker did. Because of the debt burden. If you raise interest rates, that means you have a higher interest expense. And to just put this into perspective, the U.S. government's debt now is about $20 trillion. That's just the direct debt. That doesn't include all the contingent liabilities, which is over $100 trillion. But just the direct debt is $20 trillion. If interest rates go up 1%, that's $200 billion added to the U.S. government's annual expenses. If interest rates go to a more normal level, like 5%, that's $1 trillion of added interest expense a year. The U.S. government only takes in $3.2 trillion in revenue. Are they going to cut back $1 trillion spending in other areas to meet this higher interest expense? Or are they just going to raise more debt to pay off the interest expense? It's logical that they're just going to raise more debt. And when you get into that kind of scenario, you're basically in a hyperinflationary scenario. We would be in hyperinflation already if we were at normal interest rates. The federal government, the Federal Reserve, has lowered interest rates and kept them near zero because the federal government cannot afford to pay a high interest rate. That's true for many over-leveraged countries around the world. So we're right on the precipice of basically currency destruction. Mr. Volcker, his choice was back in 1980 was to save the dollar and crunch the economy. And that's what happened. We went into a very severe recession in the early 1980s. But today, you cannot raise interest rates. So to me, the dollar is ultimately going to be destroyed as well and lose a lot of value, notwithstanding this euphoria that's surrounding the Trump election victory and his soon-to-be inauguration as president. A dollar to remain strong needs economic activity and a sound financial balance sheet. We don't have that in the United States today. Should we get into the silver point, or do you want to follow up on that?
No, I want to ask you about silver as I did before. The being so industrial, and with China and India in the picture now, and becoming some of the richest countries on the planet. This is going to affect silver much more than the 1970s did.
Yeah, silver is interesting. First of all, let's look at gold, because gold is its demand, its usefulness, its utility comes from its role as money. It doesn't circulate as currency as much today, but gold still is money. That's why we accumulate it. That's why all the gold that's been mined throughout history exists in this above ground stock. Gold doesn't disappear. It doesn't get destroyed. It doesn't get consumed. It just gets accumulated and accumulated. And because we use it for economic calculation, because we use it as money, the gold preserves purchasing power over long periods of time, because the supply of gold, this above ground stock, grows proportionally to world population growth. So the supply and demand for gold is pretty consistent over long periods of time. As an example, an ounce of gold today buys the same amount of crude oil it did 60 years ago. You can't say that for any national currency. But silver is a little bit different. It's both a gold substitute. In other words, it can be money as well. But it's also an industrial metal. So you've got two different demands in silver. And as a consequence, the silver price reflects two different things. It reflects whether there's a monetary demand for silver, or it also reflects whether there's an industrial demand for silver. So silver is a little bit tricky to analyze, because instead of just looking at monetary demand as you do for gold, you've got these two different components. What happened in 1980 is that silver just literally took off to the upside for a variety of different reasons, but it's people would, even back then, when gold at $850 an ounce and silver at $50 an ounce, and if you want a coin in your hand, people would buy a $50 silver, coin rather than an $850 gold coin. So you had a much broader retail demand for silver back then. Plus, there was, various attempts supposedly to corner the silver market, etc. But it went to an astronomically high level in terms of overvaluation, and we've not yet exceeded that that level of overvaluation. So from 1980 to the present, basically silver's been in a consolidation period where the weak hands that bought in the 1980s have been basically forced out, and silver is now being accumulated by the strong hands who recognize that it's undervalued. When silver eventually takes out $50 an ounce, which I think it will do in the not too distant future, the bull market in silver begins. The bull market in every other commodity has begun because we've taken out their 1980 high. Silver, we've not yet done that, but I think that's going to happen in the not too distant future. So the way to look at silver is to look at it compared to gold, and I do this with the gold-silver ratio. You know, how many ounces of silver it takes to equal 1 ounce of gold. Historically, it's about 16 ounces. So that's what it was when gold and silver were money prior to 1971. And that's what it was in 1980 at the high, at $50 per ounce of silver and $850 per ounce of gold. It was approximately 16 to 1 or 15 to 1. That's sort of the ballpark historically. In the end of at the low point in the 1990s, the ratio got up to 100 ounces of silver equals 1 ounce of gold, just to show how undervalued silver was. But today the ratio is still 72 ounces of silver to equal 1 ounce of gold. Going forward, I expect to get down to at least 20 ounces of silver equals 1 ounce of gold, if not lower. We were 30 to 1 back in April of 2011 when silver was 50 and gold had gone up that year to $1,900 an ounce. So I expected, this gold-silver ratio to fall. In other words, I'm expecting silver to outperform gold, going forward from here.
Now, there's a couple of things that are coming into play here in 2017 that were never part of the picture before. One of them is Sharia, which is a new Muslim law. I'd love for you to expand on that. And the second thing is, in December of 2016, some of the big banks have finally come out in the open. It's not even a secret anymore. There's silver price rigging by a number of large banks, and this is definitely creating a very different regulatory scenario where these banks cannot continue to do daylight manipulation. And also, you've got the Shanghai Gold Exchange, and I know you've worked in Abu Dhabi in the 80s, so you know that they're creating these clearing banks so that their oil billionaires can exchange their currency into gold and invest in the Shanghai Exchange. Now, to those of you who don't know, the Shanghai Exchange is 1-to-1. It's a totally physical gold exchange. It's not 250 to 1, which is presumably what the COMEX is right now. So, James, can you comment on the Sharia and this gold exchange and the manipulation of silver in the COMEX?
Yeah, let's start with the Sharia because I think this is going to be a big deal going forward. This is what's been happening recently is there's an initiative by the World Gold Council, which is the trade association of gold miners worldwide, where they've been promoting gold in Islamic part of the world, which is over 1 billion people who follow the Islamic religion, and in Islamic law, there's a component called Sharia, which basically relates to the money that's in use, and what's compliant with Sharia law and what isn't compliant with Sharia law. And as far as the money is concerned, money is physical gold and physical silver. It's not paper representations of gold or paper representations of silver. So what the World Gold Council initiative is to promote the use of gold and silver as a Sharia compliant money. And I think we're going to start seeing a lot more on this in the months ahead, and that's going to, I think, be a significant new source of, or let's say growing source of demand from the Islamic world for physical gold and physical silver, which will be positive for the price of the precious metals. With regard to the price fixing and price rigging of the gold and silver prices, this is nothing new. The Gold Anti-Trust Action Committee was formed back in 1999 in order to expose all of the price rigging that was going on. The logic for the price rigging of the precious metals from the government's point of view is that if you're going to control interest rates, you also have to control the interest rate of gold. Gold is basically, it reflects the natural interest rate. You know, interest rates are a measure of risk. So if a currency that has a lot of risk associated with it, you know, the risk of debasement, the risk of inflation, will have a high interest rate. A currency that's better managed and has a lower inflation risk or a lower debasement risk will have a lower interest rate. So, for example, the Swiss franc has a lower interest rate than the South African rand, because the South African rand is a much riskier currency than the Swiss franc. But gold has the lowest interest rate of all currencies. And the reason is that gold cannot be inflated. You cannot create gold from thin air, like you can create bookkeeping currencies that of various nations. So gold has the lowest interest rate. Now, if you're going to manipulate the dollar interest rate or the euro interest rate, you have to manipulate the gold interest rate too. And in order to do that, you have to manipulate the gold price. But what we found out over the past few years now is all of the work that GATA has done for over a decade is coming to fruition, in the sense that there have been numerous court cases, there have been numerous disclosures, there have been numerous judgments, and there have been a lot of fines of these big institutions that have been manipulating the gold price. The link that's still missing is these institutions are manipulating the gold price to profit from it, but they're doing it under the control and command of governments, because governments want the gold price to be manipulated in order to keep interest rates low. So that's all coming out as well now, and I think, you know, people are starting to understand and look beyond you know, some of the old thinking that no longer prevails with regard to the gold price manipulation. It's now a known fact, and I think people are going to be less concerned about governments going forward, because at the end of the day, any government or any group of governments is not big enough to control the market. People will always do what they want to do to protect their wealth. And they will buy physical gold, they will buy physical silver, regardless what governments do. We've seen this happen throughout history, that the free will of people is more powerful than any cartel of governments. So I think that the gold price manipulation is going to be less an issue going forward. And as a consequence, gold's going to go back to its fair value, as is silver. And both are very undervalued now, and silver is very undervalued to gold. So I think you're going to see both precious metal prices moving much higher not only in 2017 but the years ahead, and that they're going to eventually return to their rightful and traditional role at the center of global commerce, as governments and their central banks start to recognize that, yes, we have to go back to a gold standard like we were on prior to 1971. And then the third point that you were raising about what's going on in Asia, yeah, you know, you can feel the shift. It's been underway for a number of years. The bottom line is that gold goes where the wealth is being created. And right now, the wealth for a number of years is being created in Asia. So you've seen these huge gold flows from the west to the east. And I think that's likely to continue. And it's not just a question of wealth being created, but also wealth being protected. So a lot of people in China, for example, are concerned about the exchange controls that are becoming more and more strict, limiting their freedom of movement of their capital. So I think you're going to see more people seeking things like gold and even alternatives like Bitcoin in order to have protection for their capital, and taking a more global view and placing some of that wealth they've created in China and putting it in other parts of the world. We've seen that already to a large extent. We've seen it in stock prices going up. We've seen it here in London, where I live, in terms of property values. Property values in other places have gone up as well, like Australia or Singapore. So I think what we're dealing with now is the results of 8 years of zero interest rates, 8 years of a lot of money printing, 8 years of manipulation of gold price keeping it lower than what it should be, and also 8 years of interest rates being lower than what they should be. I think all of this is starting to break loose, and maybe the impetus for this is Mr. Trump and the way he's waking up people around the world and addressing issues that other political leaders have been reluctant to address.
Sure. I want to speak to you about, look, we love precious metals investing at Wealth Research Group for two reasons. One is wealth preservation. It's just simply the most astute way of saving your capital. So lower gold and silver prices is good for people who want to accumulate the physical metals in order to preserve purchasing power. On the flip side, as an investment, you really want gold and silver prices to rise and position yourself in mining stocks that are much leveraged to the price of gold and silver and profit from that. Do you also trade both of them? Do you also create a funnel where you allocate some of your savings each month or each 6 months, a quarter, or some given period of time where you say, hey, I'm going to accumulate more physical, and then on the flip side, you look at the cycles in gold and silver shares and position yourselves with the best companies that you can find in order to increase your wealth through these commodity cycles that are going on?
Yes, exactly, and it's good that you've separated the two because they're very, very distinct from one another. When you look at your portfolio or your accumulation of wealth, you've basically got two different categories. You have your investments. That's where you put your money at risk in order to generate cash flow and hopefully create more purchasing power, more wealth, more money in the future. The other category is the money itself. Money really, and particularly when you own gold and silver, they're not really wealth creating. Gold is a sterile asset. It doesn't generate cash flow. When the gold price goes up, basically what you're doing is you're moving purchasing power from people who've already created some wealth and received purchasing power for that. You're moving the purchasing power from the hands of people who have the currency that the price of gold is going up in. In other words, the purchasing power is moving from the currency to gold itself. But gold isn't creating wealth because it doesn't generate cash flow like investments do. So what you need to do is you need to determine, how much money do you want and what type of money do you want to hold? Do you want to have national currencies with no interest rates and the risk of losing your money in a bank failure or some government, like happened in India? They decide to go cashless and take away all your dollar bills, or maybe freeze bank accounts like occurred in Cyprus? Or do you want to hold money that you own, which is gold and silver? When you own physical gold and physical silver, it's money that you own. So, that's what you have to ask yourself about the money part of your portfolio. Then when you get into the investment part of the portfolio, what type of investments do you want? Do you want to own mining shares? Do you want to own oil shares? Do you want to own real estate? And all of the other myriad of different investments that are out there. And the key to successful portfolio management is always, accumulate the undervalued assets and get rid of the overvalued assets. It sounds easy, but it's very, very hard to do. But those are the basic principles. And when you use gold and silver as money for economic calculation, in other words, when you price goods and services and measure the cost of goods and services in terms of ounces of gold or ounces of silver or grams of gold or whatever, that's how you perform successful economic calculation. You'll really get a handle as to what's happening to prices. I like to use the example that we say that gold goes up and down, but in reality it's the currencies that go up and down. And the way I like to explain this is that if you're standing on a rowboat looking back at the shore, you would swear the shore is moving up and down, but we all know, of course, it's the rowboat moving up and down in the waves. But if you're standing on the shore, you can see that rowboat going up and down. So the thing is that if you're standing in the rowboat looking at the shore, that's calculating prices of goods and services with fiat currency. Instead, stand on the shore and look at the rowboat. When you're standing on the shore, you're calculating the price of goods and services using gold rather than fiat currencies. And that will be a very effective tool as you manage and build your portfolio.
And I understand completely where you're coming from. I want to ask you lastly about the mining shares. Their largest expense is energy, is oil. And oil prices have been very low. Now they're picking up, but they're still far from the three-digit prices that we've seen not too long ago. Wages are very stable, and so the price of paying the workers, the miners, etc., the admin, everyone involved with the company is very stable. And so do you see these two factors profiting the margins of these mining companies perhaps for the first time in a while? I mean, we've been looking at gold and silver shares since 2011, and only in 2015 did we see the bottom coming in, and then 2016 we catapulted higher. Then we corrected the indexes. The indices of gold and silver went down from September until now. There's a lot of stocks that went up. If you choose specific stocks and position yourself with specific stocks, they can outperform the indices by a wide margin. But do you see overall, as a sector, that these two factors, low oil prices, stable wages, and the lack of new discoveries, making every good news that companies come out with very explosive and very value added for the shareholders?
Yeah, I do. And there's a third factor as well that will help margins, rising gold and silver prices in the year ahead. So I am quite keen on the mining shares here. I think margins will be expanding. And as investors see those margins expanding, that means the multiples will probably be expanding as well. So I do think that the mining shares have a place in people's portfolios if they're prepared to take the risk, because there are a lot of risks associated with mining shares. They're big sitting ducks in a lot of countries that want to confiscate wealth, as we saw in Venezuela as an example. But given the risks, I think there is an opportunity to have a diversified portfolio of mining shares. But more generally, I think people should be focusing on any shares of companies that are involved in tangible assets. I'm quite bullish on anything related to mining, agribusiness, oil even, commodities generally, anything that's related to tangible assets rather than financial assets. I'd stay away from, banks, credit card companies, anything dealing with debt and financial assets. I think that's the big difference. They say it's not a stock market, but a market of stocks. I think the tangible side of the stock market, or shares that are involved in tangible assets, are going to continue to do well as inflation rises in the years ahead.
James, thank you very much. James Turk, founder of GoldMoney. This has been a great interview. Where can people find out more about GoldMoney, what it is? Why don't you share with people a little bit? And GoldMoney.com is the website. I'm the founder of it. We started back in 2001. We're managing approximately $2 billion of assets that have been placed, gold and silver assets have been placed in custody with us. We can also, users can also use gold and silver as a form of currency, making payments with gold and silver online. So go to goldmoney.com. There are three different things to look at: Gold Money Personal, Gold Money Business, and Gold Money Wealth. And hopefully your listeners will find it to be very useful and beneficial to them. James Turk, thank you very much. This has been a great interview. Thank you very much. James Turk is one of the foremost experts on gold globally. What I want you to take from this interview is the fact that Mr. Turk sees gold and silver bullion as money that you should own completely without counterparty risk and without the threat of devaluation and hyperinflation. We wrote about these potential overhanging debt clouds at wealthresearchgroup.com/bank manipulation and wealthresearchgroup.com/crisis. In fact, we focus much of our free newsletter the strategies of protecting wealth. James sees Sharia, Muslim law, as a potential for price increase due to a flood of new demand, and precious metals investors could be in for an amazing bull run. Learning about resource investments and their cyclicality is the key. Our exclusive reports are wealthresearchgroup.com/takeover targets, wealthresearchgroup.com/dead dollar, and wealthresearchgroup.com/resource legends. Resource investing takes discipline. And lastly, Mr. Turk addresses commodities in general, and that owning them is wiser than owning the financial sector today. We wrote about critical minerals and their importance, and you can learn about them now at our limited edition reports, wealthresearchgroup.com/critical minerals, wealthresearchgroup.com/uranium riches, and wealthresearchgroup.com/mega zinc. 2017 will be a pivotal year, and you'd want to own steroid stocks, which are mining shares owned and run by the best management teams on the planet. And you can read our exclusive reports about how to invest in those at wealthresearchgroup.com/steroid stocks. Thanks for watching this, and stay tuned as we roll out many more important interviews in the coming weeks and months.